But you get the capital growth in London.
You do, but then does capital growth pay the bills? Hello everyone and welcome to today's video. Now I am with, who am I with?
Davinda Sanyara.
Also known as
Spot the Dave.
Spot the Dave. You'll notice we're both wearing yellow because it's like our favourite colour, right?
It's my property colour, it's not my favourite colour.
It's your property colour. Well, I obviously used it first. Davinda came along and just, we copied it. So anyways, moving on.
I think it happened simultaneously.
Yeah, it must have. The gods just made it happen. So
great minds think alike.
Exactly. So in today's video, we're going to take some questions from the crowd. I say take questions, this is not live, but we have questions from Instagram, don't you, on your bing,
Bing.
on your phone. So we'll name the people as well. So shout out their tags when we answer the question so that, share some love.
Yep.
But we're going to be answering questions on HMOs, B&B properties, auctions, flips,
financing,
colours, everything, right?
Yeah.
So go on, Davinda, what's the first question?
So the first question I've had is from Rupinder Pal, and it's thoughts on investing in London versus out of London.
You start.
I was going to say, I actually have an opinion on this. I have a school of thought, I have a number of school of thoughts, and it'd be interesting to see whether you agree with this, because both me and Ted, we actually live in one of the suburbs of West London. We live from quite close to each other, West London. So my school of thought is nobody goes out, and if you had all the money that you needed, you would not step foot out of your investment area. You would be buying houses on your street, and you'd be buying houses in your area and in your road, because you know the area, you know how to manage contractors in and out and manage tenants. It's easier. You might not need to pay it away to a letting agent. You might do that anyway at a later stage as you grow your portfolio. But I genuinely think, and this has been my personal case as well for me, I invest out of London for cash flow, because the yields are better when I go slightly, like when you go up north, and also my barrier to entry is a lot lower. I don't have an abundance of cash, and if I did, I'd be buying the £500,000 properties on my road. But because I don't have that, I make the capital that I do have stretch further by leveraging it further as well.
Yeah, I agree with you. I think it's the same. If I had hundreds of millions in the account, totally. Look, I may not invest exactly where I live. I may go half an hour out just because it's a slightly better area, or there's a crossrail or something. But I would 100% be doing it locally. And again, it's easy to say this, right? But even in that position, even when you invest that kind of money and we buy the houses that in the suburbs of London, the yield is still not that great.
Yeah.
So even then, I think we'd still be do we still want to invest where we live?
But you get the capital growth in London.
You do, but then does capital growth pay the bills monthly? That's always my response. Maybe I just don't understand it fully.
No, you make a good point, because you definitely get more cash flow further away from London. But then it's like what your view of property is. So I have a long-term view. I hold assets and I want to hold them for 25 years. I feel like it's against my religion to sell, if I can make a controversial statement. But no, so if I have that 25-year view, I want to see the capital growth. Even when I'm investing in properties outside of London, I want to see the fact that if I did sell it in 25 years time, or 10, 15, whatever reason, that there was some uplift in the property value. So yeah, but for cash flow, obviously, you don't get it. But then I think if money was no barrier to entry, you'd be buying those £1 million properties to get that 40,000k income, although you can probably go up north and buy something for 200,000 to get the 40k gross rental income, and have less debt. But
I agree with you. I think it's convenience. When you have loads of money, you want convenience. When you don't have money, you're okay, I'll hustle to make money. So it depends on your situation. So Rupinder Pal, if you have tons of money and buying in London is no thang, I would say go ahead and do it.
Yeah, do it.
But yeah, if you're kind of hustling and you want to maybe build a portfolio that is statistically going to give you more money and the numbers are better, then you'd have to go out of London. But it's not easy to invest far from home.
No.
Even if it's an hour and a half, it's still a 3-hour return journey.
Of course, definitely. And there's a lot of things that you have to leverage your time and your energy and trust people that you're working with, and things do naturally go wrong anyway.
Yeah.
I just wanted to finish off that saying thoughts on investing in London versus out of. That I think like our responses only really apply if you live in London. If you like live in Leeds or Manchester, you would be investing in Leeds or Manchester on your doorstep. So
yeah,
you know, you wouldn't be going from Manchester to invest in London unless you like had again abundance of cash and you wanted a capital growth strategy.
Yeah, and when we say London, I think we also more mean sort of greater London suburbs. When it comes to prime,
yeah,
I don't think either of us have a ton of experience in that at all. And the prices in prime are here, and rental is pretty much here. So
yeah. Agreed.
But luxury SA might work in prime, so you know something will work.
Okay, so next question: which colour should Tej switch the yellow to?
And that's from
the silences.
Oh, it's a bit more difficult than that because we're not silent. Oh, we look now. We're talking.
Yeah, true.
So in answer to that question, I
should just start you.
Sorry. No, because then it's easy for me to cut when it's.
Sorry.
So in answer to that question, I think I'll answer it what you said earlier, which is if I was to start again.
Yeah.
So firstly, I wouldn't choose a different colour. I love it and I still love it. But I honestly think I would do like a hot pink. Some people call it fuchsia, but it's not. It's like a hot pink.
Nice.
Because again, it's bright. I think it would suit me. I have a jumper in it. I don't know if you've seen it, but it's quite a nice jumper.
Yes, I've seen you.
Thank you. And I think, again, I mean, look, because it's black, the Tej talks, and because it's two colours, any colour will work.
Yeah.
But I think like a hot pink would match my personality.
Okay, colourful and stands out.
Yeah, there we go. And I also think it would catch people's attention, especially on a podcast app, because which podcast is bright pink? I mean, none. I mean, there's a tip for people who are starting something.
Podcast, yeah.
You know, maybe do a colour like that. What colour would you choose if you had to?
So I actually debated between yellow. So my thing with yellow is that all my front doors are bright yellow. But before I was going to do yellow, I wanted to do red.
Oh,
so
interesting.
Bright red is my favourite colour. So I'm getting married in it next year. Just because it's like the Indian kind of colour. So getting married in bright red, love it, love like, you know, ruby woo red lipstick to all the MAC fans. So I was debating between red and yellow, but red is my colour, like I love red. And so I didn't want my property business to be my colour. I ended up kind of like having an internal debate and regretting that a little bit later. And now I've done a 180 and gone back and I'm like, I love the yellow. So mine would have been bright red, and I actually just debate between bright red and yellow.
Both primary bright colours and, you know, amazing. Next question.
So next question, what do you prefer? A traditional mortgage, angel funding, or peer-to-peer lending, and why? So finance question. And that's from our mortgage broker, which is Akil, who is a mortgage broker, and he's also asked me another question, when is he doing my mortgage? So I haven't actually used him yet.
Good question, I like that. Generating new business. Do I prefer mortgage, angel funding, or peer-to-peer? For me, I prefer angel funding. I think only because of what you have to do. If you buy with a mortgage and you remortgage 6 months later, yeah, you can probably get away with it a few times, but they're not really going to like you. It's a 25-year product. Don't be stupid. So for me,
can we just clarify with that, because you were old over it, just in case some like
go for it.
Viewers don't understand. So what Tej meant on that is, when you traditionally mortgages are like 25 years, banks make money off the interest. So if you bought with a buy-to-let mortgage and then you refinance that 6 months later onto a different product with a different lender, essentially like your intention was never to hold that mortgage for 25 years. Of course, if your circumstances change and you did that's okay. But essentially, you know, getting a mortgage, and a lot of investors do this. They buy, you know, properties with a variable product because then you're not hit with an early repayment charge 6 months later. So just wanted to clarify.
Yeah, and some courses will just say to you, you know, buy with a mortgage, or they won't tell you how to buy. But really, you have to use cash / angel money / bridging. Yeah. So for me, I prefer angel money or bridging because it's the only sort of real way to do the method of refinancing.
But now, the fact that you're saying that strategy, it actually makes a really good point into what you do and what I do as well.
Yeah.
So your strategy, because you buy rubbish
yeah,
below market value,
yep.
So you're going to add the value and then you're going to refinance later. So actually, your answer to that question, why you prefer angel funds, is because of your strategy.
Because of my strategy. If you're just buying houses and you want to leave the deposit in and you just like got money to just park, then yeah, buy-to-let mortgages are the best because they're the cheapest.
Yes, definitely.
Yeah, they can be slow, but sometimes they can be 4 weeks-ish.
Yeah, maybe 6 to 8.
Maybe 6 to 8. So yeah, for me, because of my strategy, and great point there, I prefer angel first, because dealing with a human is so much nicer. Although I have great bridges, but dealing with a human is always a bit nicer, and it's relationship focused, and I don't know, I just prefer it.
Yeah,
really.
Definitely. I think, so we do similar kind of models. Obviously you do buy-to-lets, I do HMOs, but again, we both buy dives. Like, you know, one of the agents always emails me, and because I'd written in a Christmas card, if it stinks of we, think of me. And that's what they email me. It doesn't stink of we, Davinder, but we did think of you. So I buy rubbish below market, I try to buy below market value, but in my investment area it doesn't work. But then I add such significant value, I get an uplift anyway when I do the refinancing. So again, I have bought with a traditional mortgage when I did my first buy-to-let, which was with a 2-year product, and then I refinanced that later. Of course, interest rates are super low, right? We're in an all-time super low interest rate environment. On a buy-to-let, I have a less than 2% mortgage product. It's 1.98%.
Oh, damn.
And I know investors. Actually, it's not an investor. I know someone that had a residential mortgage that was less than 1%. So, if you're not tapping into those like low interest rates, you know, your either credit rating is really poor, so give yourself 3-6 months to fix it, because you can fix it. Or just, you know, like do creative things where you can tap into those lower interest rates, and speak to mortgage brokers that might be able to give you those solutions. So I have bought traditional mortgages, you know, they're really low interest rates, love it, but then that's for a long-term hold. And then I do similar strategy to Tej, so peer-to-peer lending, angel finance, and bridging have been, you know, sources of finance that I've done in this past year, and just what is my strategy. Similar to Tej, I love working with people. I love working with humans. You can be a little bit more flexible. You can, you know, show them what you're about. You have your values and what you stand for, and people are essentially buying into that. And I've done crowdfunding, so I've crowdfunded 3 of my deals, and what it's done is it's just decreased my barrier to entry. A little bit more expensive because it's a short-term thing, and it is like bridging, and it is for a short-term kind of period, so I would have to have a clear exit at the end, whether I pay out the short-term lender or I get another, you know, a refinance onto a long-term kind of specialist lender. The other thing with like angel investors, I'm very aware that I'm borrowing funds to build up my business, and we had a chat about this actually, that you know, in 10-20 years time, when I become a money lender to somebody else's business, and you know, there's a little Davinder or a little Tej running along, like inspiring me with their like attitude and their go-getterness and just their drive and passion, I would invest in them, you know. And so just the same way people have helped me and invested with me, I would want to reciprocate that when I'm in a position where I can do that. So, and you know, there won't be those big like kind of tick box exercises that banks have, like, you know, first charge, this, that and the other. You know, I've borrowed funds where I haven't offered charges to investors, and they've believed in my vision, and they believed in what I'm doing. You know, and things can go wrong, but you know, we talk about that and we have that clear discussion. So I think like working with investors and working with humans is always going to be, you know, over computer says no and computers for me.
Yeah, and we're doing a whole video on financing, aren't we? So we will get to that in another video. So what is the next question, Dave?
So
what do people want to know?
There's been a few HMO questions, but I think we'll change them and make them specific to buy-to-lets and HMOs. But so the first one, I guess, when you carry out works to a buy-to-let, it was actually specifically HMOs. This is by Luca Vital. When you carried out your first HMO, how confident were you on the end value prior to works? And that kind of, you know, is a question to you. How...
So with buy-to-lets, I think it's probably easier than HMOs because every house is a residential house naturally. There's, you know, 100,000 normal houses for every, I don't know, 1,000 or so HMOs.
Yeah.
So when you look at like comparable data, which is basically Rightmove, Zoopla, on the market, net house prices, mouse prices, and looking at all of them, I have to be very secure. You can see what houses have sold for in your local area. But with it, I think, and you'll get to this, with a HMO, you know, you may not know if that was a HMO that it was sold at, and I guess HMOs are not always sold, whereas for me, with houses, there's kind of a high turnover, right? First-time buyers, investors, whatever. So I use all of these data points, which often are the same, but sometimes there's disparity or there's differences in the pictures. And I then work out, okay, what is the likely value of this house? That's one aspect. The second is speaking to agents. Agents are gonna add a ton of sauce to the price.
Sprinkle that masala.
Sprinkle it all on it. But actually, where I invest, a lot of the agents are bang on. Like honestly, really? I can't fault them. So now, but even then, I'm always like, okay, they've said 90. I think sort of, I see 90, but actually, in my sums and for my investors, we're gonna say 85.
Yeah.
Because of possibility of a down val, because of Brexit, whatever the hell that even means anymore.
Yeah.
Because of life, I will take off 10%, 5%, whatever.
And you want to cover your costs in case your refurb costs are higher, or something happens and you want to cover your back. It's a business, it's an investment. And
it makes it a better deal, right?
Yeah.
If it works at 85 and then it works even better at 90,
exactly,
you're winning. And your investors are protected, definitely, which is super important. So for me, it's all about the data and speaking to agents and also looking at what's on the market for sale. Again, this is like, look, you could say, oh, my house is worth 200 grand, and we're just like, mate, it's worth 150.
Happens all the time.
Yeah. So don't let, don't let things that are for sale affect your price hugely, but let them give you a bit of confidence.
Yeah, sold comparables is key.
Is number one. So on to you then. Is anything different you do maybe for HMOs in particular?
It's a little bit more difficult with HMOs because, as you just said, that there won't be sold prices of these. There won't be a sold comparable. So you're never right. You're never 100% right. You're taking a risk anyway. And I think like what Ted just said about using data that's out there to make an educated guess and to make an informed guess. And that's all we do as property investors. When I was looking at my investment area, even now when I'm looking at like properties, I find it really interesting though, how sometimes estate agents value properties. So I must have educated an agent. I put an offer in £150,000 less than what it was on the market for. Actually 180, I think, less.
Cheeky or what?
But I was looking at data. I was looking at net house prices, I was looking at house prices, I was looking at Rightmove, and the data was showing me sold comparables that was 18 months ago on that road of that price. That was 150,000, £80,000 less. So I put an offer in. It obviously got rejected, but that weekend I'd had the email conversation with the agent. They reduced the offer price on Rightmove Zoopla by £50,000.
I've never seen that.
So, and that's not even in London. This is crazy. This is not even London. And I actually looked at when the property had gone on the market. It was 30th of October and we'd had the email conversation. It was the 16th, 17th of November. 2 weeks later, they reduced it by £50,000. That's absurd. That's unheard of. And it was me educating the agent, and I was just like, this is what I believe it's worth. This is what it's worth to me. So I just stick to my numbers because it's an investment purchase. So I'm still sticking at that property. I'm chasing it up. But again, you're never going to be confident. You never know. When you do bigger deals, you never 100% know. It's just speaking to brokers again that maybe have financed these bigger deals. So you said speaking to agents. My thing was then brokers. I was always talking to brokers like, okay, tell me about what lenders there would be. What have you put through that, a 5-bed ensuite HMO has refinanced at? And I would talk to brokers and then go with the broker that I was really confident with that they could push that through for me because they had the business or the relationship with the lender.
There we go. And also you can use end values end values will dictate your offer. So when you speak to agents, like you said, you can say, look, here's what the stats say it's worth. Yeah. Why are you valuing it 50k more?
Yeah.
Sometimes I'm just like, oh, but the internet says this, So there's ways of communicating and using end value to secure a deal as well. Ooh, who's next?
So it's Gurpreet Kaur.
Hey Gurpreet.
How to know if I'm getting a good deal at auction?
Okay.
So this is a good one for you because you've bought properties in auction.
Yes.
I have not yet. I've sat in auctions ready to bid and then got frightened because it went over. It got above my.
Bidding's fun, it's not good that it's fun, but it is fun. It's a bit of an adrenaline rush. Okay, how to get a good deal at auction? Okay, cool. Let's run through. So the first thing is, and we discussed this.
Yeah.
my honest advice is to go to auctions from day one.
Okay.
But sit on your hands. Don't even register. Like, you ain't got no money in this room. Just watch.
I've done that.
You know, just get a
when
vibe
I didn't have any money anyway. Well,
yeah.
So I could...
Well, there we go. Exactly. So go to auctions, but don't necessarily bid until you know your area, until you know your numbers, till you know if a crack is structural or not. If you know, to be honest, in my opinion, quite a bit about houses, structures and building work, because what you'll find in auction is there's a lot of properties that have cracks, that have old subsidence, or maybe it's current, or they have problems that most homes under the hammer investors are like, I can't paint over that crack, so I'm out of this. And actually you hear them on auctions like, oh, it's got knotweed, oh, it's got this, and I'm just like,
everything's solvable.
Yep, I'm like, cool, keep walking. And the thing is, right, you just won't know this stuff unless you're a structural engineer. You just won't know this stuff
by just looking at it.
And you won't know it until you've bought a few properties, done a few refurbs. You know, ooh, lath plaster, okay, that's an extra couple of grand, or ooh, that's not plumbed. And once you know these things, then start going to auctions. When you go to auctions, I have two good friends, Jay and Piotr. They've got a really good book out called Before the Hammer Falls.
Yeah.
They say you should go 3 times. You should go to view a property 3 times. I don't. Sometimes I get the auctioneer to send me a video because of the relationship.
Okay, so they say view the property.
They say view it.
Auction property 3 times.
Oh, and they usually have 3 viewings, so they say go to all.
Okay.
I used to, but then now I'm out here viewing 220 properties, and I've bought X many from auction. I'm like, yes, that's a normal ratio, but I'm also like, I didn't need to go to both viewings.
Fair enough.
And now I'm at a point where I don't even need to go to the viewing.
Okay.
I'll get someone who does it for me, who's an investor, or I'll say, auctioneer, because of the relationship, send me a WhatsApp video, and they're like, okay.
Oh, nice.
Cool.
Yeah.
Okay. And that's the power of the relationship, right? Which is important. So, at the start, go to as many viewings as you can, just to really take in things and things you might miss, and you get to network with people. I've met friends I've made friends, met friends.
Nice, interesting.
I've met my letting agent at an auction.
Okay, cool.
Too. So, go to as many viewings as you can. When it comes to legal packs, this is again a point that people are going to shake their heads at me. I don't pay a solicitor to read my legal packs. Because, I think if you have...
But I think, is that because you're experienced now?
Yes, yeah, 100%.
So you know what you're looking at?
At the start, I mean, I never did though, but at the start, so here's what you should do. As soon as you get into property and you're considering auctions, just download legal packs, just read them.
Yeah.
Just read them and think of a list of questions like, ooh, what does that mean? What does that mean? And then say to a solicitor, right, I want half an hour with you. How much will it cost? I want to run through some terms.
Yeah.
And build your knowledge up that way, because some solicitors, this is mad, will charge £800 to read a legal pack. Okay. Even if it has like 3 or 4 documents, which honestly, in my opinion, anyone can read with the right amount of training. So my solicitors will do it for you for about 180. So get in touch if you want to get them to read it. But just start reading them. Yeah. And also, here's a really cheeky, typical cheap Indian tip. Yeah. If you're in your investment area, all the legal packs of auctions will have environmental searches. Or it should. Yeah. So save them all, and the next time you're buying a house in the area.
Oh, it's there. You've already got it.
Because a lot of them have radius maps.
They do have a 5
I've got searches for towns.
Nice.
So there's a tip to save money. But yeah, read the legal packs. Don't be a joker like Homes Under the Hammer and say, oh, I didn't read the legal pack. I thought it'd be okay, and then I end up buying a shed instead of a house. Don't be that person, because they're on TV, we've both seen them. Yeah. Read the legal packs, go to all the viewings, do your due diligence, but have a bigger contingency, because people are putting stuff into auction for a reason.
Yeah, because they want a quick sell.
They want a quick sell, and they might be hiding something.
Yeah.
You wouldn't put your beautiful HMO in auction, would you?
Exactly. You want the right price, you don't put it in an auction. Or maybe that's the reason why you do, maybe.
I think that is, but then potentially because you're hiding something. So yeah, auctions are great. I personally say get a little bit of experience, especially in structures and refurbs, before buying at them. Yeah. But just remember, you're going to attend loads of auctions, you're going to make loads of viewings, and you'll get this many accepted.
So although I've never bought a property through a traditional auction, I have bought one last month through the modern method of auction. Oh. So basically it's like £6,000 of upfront fees that you pay. Yeah. But then I just incorporated it into the cost of the purchase price. So I decreased the purchase price by that amount, and that my offer was reflective of that. And again, all the legal pack was online. I spoke to my solicitor. She said she would charge me a couple of £100, but she even said, Devinda, you're a bit savvy. You've done this a few times. You probably don't need me. There were a few questions. I went through the legal pack, read it. I actually emailed the auctioneer. They got back to me that day because their solicitor had was reading the questions, and they just were so keen to just get a bid and then to sell it. And obviously they could see that I was intrigued because I was asking questions, answered my questions on the day. So actually it was fine. So I paid the £6,000 and then we instructed solicitors to purchase a property. And also, so with the modern method of auction, you have 56 days to complete because they give you allowances for the fact that you might want to raise a traditional mortgage. But that 56 days starts when the vendor has passed the contract pack to their solicitor or something like that. So although I got the offer accepted like 3rd of September, my 56 days didn't start until the first week of October because the vendor was just dilly-dallying. I'd had the valuation, I'd had the survey done, the valuation report back, I'd had the architect go over in that month. It was so funny. I was like so on top of it, and the vendor just wasn't. But that worked to my advantage because then my 56 days, I had from like the first week of October, and then we completed end of November on the property.
And just on that, actually, just because I missed this, if you're going to an auction, usually it's 28 days completion.
Yeah.
Sometimes 14 days.
Oh wow.
Make sure you're pre-authorised for bridging or something. Make sure you have, on the day you need 10% plus the auctioneer's fees. Make sure you have that on a debit card. Some accept cash, but I mean, it's up to you. Yeah, just walk in like,
dodgy, right?
Yeah, no, £6 cash. But just be prepared to complete in a short time frame. Make sure solicitors can handle it. Now, when you said that 56 days, I got shivered because that would annoy me, and the vendor taking a month longer would annoy me because I love auctions because I'm like, cool, 28 days, we completing. I don't want to hear crap from your solicitor. I don't want my solicitor to have any. I just want to get it done, and that's actually why I love auctions and why I might overpay slightly. Because of convenience and because of money made, time to make money, right?
Yeah, but sometimes you're dealing with inexperienced vendors, which was the case in this one.
Yeah.
And there's just other niggles that come up. And I think in property, you just kind of have to be a little bit flexible. I think when I've got multiple projects on the go, it's easy for me to focus my time and energy and effort on other ones and stuff, rather than focus like on the one that, took a month to go through.
That's a good point. It's a very mature point, that is. That's a very mature point.
Okay, so another question from Gurpreet. How do you, so you specifically, Ted, make money when an investor pays to fund the deal?
Okay, so let's do a really easy example. So let's say an investor funds 100% of the purchase price, yeah? So
and the refund, so the entire deal.
Yeah, let's do everything. Let's say all in it's 100k. Let's just keep it easy maths, right? Yeah. If it's all in for 100k. The strategy I follow and you follow, where we buy, refurbish, refinance, it should refinance at, 140 for example. So how we make money, and I guess in my particular example is, I only leave in I leave in 0, 5k, or I take out money from my deals.
Nice, so you're doing money in, money out deals?
Most of the time, yeah.
Nice.
So what happens is, the investor gets paid back their capital from the refinance, because that covers it and might leave 5k.
Yeah.
So if it's a no money left in deal, that's fine. They're all paid back, and their interest payments usually come from the rent.
Yeah.
And this is something that, again, I think a lot of people maybe don't talk about. You see how quickly, me personally, am growing. That doesn't mean that I am making money. What it means is, it's like any startup business. Yeah. You're rocketing, but you're sacrificing, and all the money in is going to investors, to bridges, to whatever. And then at one point, it'll all flip.
That's it.
And then boom. I'll be making money like people who do essays and I have a Bentley, sorted.
Because it's only for that short period of time that you're giving it away, and that's usually for the beginning. So again, it's like that long-term view. If I have a 25-year view, even if I pay away 1 year of that investment property's income to an investor because they've lent me £150,000, the thing is, I've got the asset for 24 years, and then I've got the capital growth, then I've got the income after that, and so my properties, my HMOs that I do, the gross rental income is 30,000. So I just think I'm adding, every time I do a HMO, I'm adding 30k extra to my, net income for that gross income into my property business. And I pay it away for 6 months, maybe 12 months, to an investor, but I've got that asset for life after that, and it's okay. I'm building up my business. I'm paying away a lot more on interest, but as I do more of these, I'll have more of these properties, and then like you said, in a few years' time, it'll flip, and we'll have the cash generating in our business. So that's basically it. That's, I guess you just summed it up how we do it. We, we borrow funds from investors, we buy, refurbish, refinance, repay the investor with their capital, or they might want to recontinue and it's like, go again.
Yeah, and a quick thing which I know you don't do because it's against your religion, if I'm leaving 5k in a deal, where am I getting this from? I'm flipping. So again, all the flips I'm doing right now, most of the profit is not mine.
Yeah, okay, fine.
So I'm flipping, and I could, if I took the money from that, happy days, mate, it'd be great. But I'm not. I'm like, okay, I've generated profit. You're not getting paid back with the profit from the flip. Yeah. So that's why I do flips as well.
No, that's really interesting because a lot of property like gurus do advocate that as well, to have other strategies to complement and to make sure that the numbers all figure out. So why it's against my religion, I just don't want to sell. So that's why I want to hold everything if I can. But I don't do money in, money out. So I do leave in money into the deal. And of course, then I've got to find a way to do that. So that's where I source and project manage for other investors to make that income, and then it nets off. I've also now got a fair few HMOs that actually, if I'm borrowing funds for 12 months or 24 months from an investor, I'll use their capital, buy, refurbish, refinance, add properties to my portfolio. But now I've got a significant amount of rental income coming in that by the time the 12 months is up, I've actually made that bit that I was leaving into the deal from my income. Yeah. But for my first 2 HMOs, I didn't have that. My investor knew we were going to leave 40, I think it was we calculated 20 to like 50k into the deal. It ended up being about 40, and he was comfortable with that. He's like, oh, I love it. I want the interest rate. I want the interest. And we had this very transparent conversation before he'd even invested his £150,000 with me, that this is something that he would be comfortable doing. And, he was fine. So
there we go.
Yeah.
Love it. Next question.
So I think we're nearly out of questions. Oh, so this is again from Rupinder Pal. I feel like this is more of an accountancy question. Should you open a company if owning more than one property? Why, and pros and cons?
I think that we should just avoid the question.
Okay.
Because, and you know what, even be very careful who you ask this to, because ask an accountant.
Ask a property accountant.
Ask a property accountant, but also ask a property accountant who invests themselves, but also ask like a tax structure financial advisor as well.
Okay.
Because some accountants are clapped and they just say, oh no, in your own name, and then some.
Yeah.
It's tricky to get to the bottom of it, but there's pros and cons to everything. But ask the qualified people, because we own limited. We do limited companies.
We do limited companies. I do have properties in my personal name as well.
But it may not.
But again, exactly. Just speak to a professional. Speak to an accountant. What is better and what suits you, because they'll go through the numbers. And it's always best to get like sound advice. I have a rule of 5, so like I would speak to 5 property accountants, I would speak to 5 brokers, 5. I don't do it now, but obviously when I was starting up, 5 solicitors.
Like that, yeah.
When I was trying to get comfortable with who I wanted to give my business to, who did I kind of connect with the most, if I build a relationship, if I work with you, I want to be working with you for 5-10 years. If you're my solicitor, we're doing multiple properties together. So I put in that kind of like testing, speaking to 5 solicitors, getting recommendations. I'm all about getting recommendations and speaking to as many people as possible as I can. But then I have my rule of 5 to try to speak to people and to get comfortable with them. And essentially they're the one that I want to work with for, the next 5-10 years.
I like that. Any more questions?
No, that's it. That's all the questions.
Amazing. Well, thank you very much for tuning in, everyone. This is part of a short video series that you and I are doing together.
Yes, we are.
We need to name it something. Something. We'll think of a cool name. It'll be in the title by now. So please like and subscribe to my channel, Tej Talks, and follow @SpotTheDave on Instagram.
Yeah, Spot the Dave on Instagram, which is over there.
Up there.